You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, here we are. It's Friday morning, and the markets are fascinating.
Weaker commodities and widening credit spreads. Connected, are they?
Yeah, the media are discovering that commodities are weak recently. I think it's focusing on crude oil, which is slipping, but generally commodities have been declining since what we took as a cyclical peak in 2011. I mean, there was huge energy on the way up. By energy, I mean, momentum and stuff, and it triggered off our momentum peak forecaster, which doesn't come in all that often, but when it does come in, it means that the party's pretty good. So at any rate, that was calling for a secular bear market in commodities, and they have continued. And so we're sort of at lows on any of the, like the CRB or the Deutsche Bank, DBC, commodity index. And at the same time, and there's no talk about this one, is the credit spreads, U.S. corporate credit spreads, the difference between high or investment grade bonds, treasuries, and triple B corporates. Those spreads have been widening. Now, on spread action, when there's lots of confidence in the market, people will buy and bid up lower grade bonds because they assume the risk has gone away. So then they narrow. And then also there's a seasonal component in it. But at any rate, looking at the junk bonds, J and K, they surged up to a terrific high in June a year ago. And then as crude oil started to come down and other commodities went down into a panic in December, because there was, something 18% of junk bond issues done were related to the oil patch. So when crude came down, it was unpleasant. But in general, when commodities come down, it suggests that it also is not just with resource stocks and commodity stocks. You get a major decline in commodities, it suggests that the economy is slowing, and it also indicates weakening pricing power for most any sort of commerce, business, or industry that you're in. And then when you can't raise your prices and your costs are going against you, or you're facing falling prices, then your cash flow and earnings diminish, and then you have problems covering debt obligations. So the rating agencies have a tendency to watch for the ability to service debt, and so there you go. Weakening commodities, weakening economic activity, pricing pressures, cash flow problems, and then the inability, if it continues, the inability to service debt. So this is where now you have a seasonal on credit spreads too. They have a tendency to narrow into May, June, and then reverse, and that's what's happened this year. So this year is particularly interesting on credit spreads because the action is similar, excuse me, to this time in 1998 when widening of spreads took out the biggest hedge fund of the day. They had $4.5 billion. And the turn in credit spreads happened in June, and then in early July you kind of had the trend extend itself, and then in late July, early August, the trend really did break out, and that put the paid to the huge speculation in LTCM. So it turned into a disaster. And then I just looked it up the other day that when LTCM was facing the problem of having spreads widen, they were leveraged against spreads narrowing. It was called the convergence at the time. So they were offside, and then you had on August 17th, suddenly the world discovered that Russia may not be able to service its debt, so then you had the panic of the Russian bonds. Well, then that became a free-for-all for all lower-grade bonds, and a huge disaster that concluded in October of that year. So then moving ahead to 2000 with the bubble there in the high-tech bubble, the widening of credit spreads and the change in the yield curve and the top of the market were all pretty close together. And then we get out to 2007 when, with great enthusiasm, people were buying junk and narrowing spreads right into May, June, when it started to reverse. And then that revealed some people have been partying excessively, because early June 2007 was announced that Bear Stearns, with their leveraged funds, had a problem. So then, of course, the establishment said, no problem, because the Fed can fix it. So then the stock market then peaked in October and went into the bear market. But then there was some relief in the stock market in the early part of the year, 2008. And then again, you had the narrowing of credit spreads into June, and then the reversal. And again, the same pattern as in 2007, where the breakout, the extension of widening trend was noticeable in early July, and then the more serious breakout occurred at the end of July, early August. So, and then you went into the real panic in the stock market into the fall. So here we are now. You've have had a lot of enthusiasm for spreads, the narrowing into May, the reversal to widening, and now you had the extension of the widening trend accomplished early in July on schedule, so to speak. And then now here we are, we're looking at the spread, and it's at 210 basis points, or beeps as the trading desk call them, and it needs to get through 212. That was the high with the panic in December. So we are getting seriously widening in August, which I would say is also on schedule. So that, combined with weak commodity prices, is not a healthy recipe at all.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye, market historian. Bob, do you ever wonder why people don't look at the charts like you do when certain situations are set up? Gosh, maybe we should do this. Like you said, people were surprised to find the widening credit spread. What else are they being surprised with right now?
Well, that's a good question. There's a lot of people dealing fundamentals out there. Some are successful, but the charts really are amazing to watch. And nowadays you can get everything charted in an instant. And you look at a chart here, like, for example, the whole composite New York Stock Exchange here had a nice high in, in May, and tested that at lower highs. So then it gets under the 50-day moving averages that's heading down. And then now it's below the 200-day moving average, and the last rally to a week ago couldn't get above it, tested it again, and then now it's fading. So its stock market is rolling over. And then you take a look at the chart on the advanced decline lines, and at the top of any bull market, the number of hot participants declines. So in the early stages and before a market becomes mature, the advanced declines are wonderful. Everything's going up, and then it becomes more selective. So the advanced decline lines peaked in April, and in past bull markets, that peak, you could have the stock market, the senior indexes, continuing up for some months after the peak in the advanced declines. And then also in April, remember, margin outstanding on the NYSE set its peak, and the numbers have been down on each month after that. So that one, we've called those our friends of the bull market, because when margin is increasing, that's a sign that it's on. And ADs are advancing, it's a sign that it's on. And then even when both peak, the tendency has been that the senior index would peak a few months after that. So we've had that on the wall here that we've been watching, and oftentimes you can get the final rally in New York, again on the senior indexes, into late August, early September. And if there's disturbed credit markets, which we have, then there's a high probability of a liquidity problem going into the fall, which is what it looks like is going to happen here. And so who cares how much of a rally you get now between now and early September? We would just, as we've been saying, use each rally to lighten up. Also, not all sectors within the New York Stock Exchange are going to peak at the same time, and that would hold for Toronto as well. So here's the idea that take money off the markets. There could be a storm this fall, and we will know next week on the serious breakout in credit spreads. And if commodities remain dull, maybe they could pause here for a while. That then confirms that there are problems out there. One other thing, in order to dwell on problems, is that the Shanghai Stock Index did accomplish a fabulous blowout and collapse that fits right with the Nikkei in 1990 or gold in 1980. These all have very similar characteristics. So then we know throughout a lot of financial history that if you have a serious problem in a highly speculative exchange that is outlying the senior or financial capital in New York or more senior market in London, that eventually that problem in the outlying region comes in and hits the senior exchange. So there's that one. So there's a whole lot of problems building that I doubt even the most aggressive central banker can cure. Also keep in mind that the reason why so many asset prices were so high is because the central bankers have spent the last few years trying to prevent bad things from happening. So it's sort of feeding on itself. Now this gets us into gold and silver, and we would have on gold and some of the gold stocks a week or so ago, we got a daily downside capitulation. That meant that the sell-off was bad enough that it could pause, it could even take a rally. But it may take a number of indicators before you really get the bottom in on the precious metal sector. For example, you'd want to have the senior gold stocks outperforming gold bullion, and you'd want to have silver outperforming gold. And there's, if anything, it's just a start on that. But yesterday, they wrote that you still have the consideration that in distress, the U.S. dollar could firm up. And in what case, when you price gold in U.S. dollars, what's going to happen? So we thought that in a storm, the investment demand for gold will increase because it is one of the more liquid items out there. And you could run into a situation where you could have a steady to firm dollar, and if it doesn't move too fast, you could have a steady to firming price of gold in dollar terms. And what's happening today? The U.S. dollar was up earlier, and so were gold and silver. So, it's just a fluke. But again, on gold stocks, there may be a problem in the big market, and that would put a lid on any advance in gold stocks. But one other thing I'm thinking about here is that is that you can get an opposite move. Say you're not in a storm and you're not in anything too wild, but you can get a condition whereby on a down day for New York or the Toronto Industrials, you could have an up day for the Toronto Golds. That is sometime ahead of us, but it is possible that you got this alternative because you've had a fabulous bull market for the big market, big stocks, equities, and NYSE, while you've had a dismal bear market for the gold. So maybe one can trade off the other. So I think there's some daylight ahead in the tunnel for the precious metal side. Today's action is interesting. I wouldn't go so far as to say it's encouraging, but there is a probability that because of gold's liquidity, it could go up in U.S. dollars, and because the urge for liquidity would be assisted by the discovery that many stocks and other asset classes are going down. So wouldn't rush into the equities here yet, but gold could be okay.
Bob, thanks a lot for chatting with us.
Good to be with you.
My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.